Okay, so there's this wild theory that's been floating around about the silver market, and it's a big one. It claims that on one single day, the financial system, the one we all rely on, secretly broke. We're going to unpack that whole thesis, starting with the moment that supposedly kicked the whole thing off. So, according to the commentary, it all went down on December 27th. The price of silver, they claim, just exploded, shooting up over 10% in a single day to hit $79.25. Now, for a major commodity like silver, a move that big is, well, it's almost unheard of. And this is the core piece of evidence for the entire theory. The person in the source video is pretty clear they're not mincing words here. They're adamant this wasn't just a good day for silver. They call it a liquidation event, even a crime scene. The whole argument is that the actual machinery of the market just snapped. So you're probably asking, how on earth could a price move that violently? Well, the commentary says to forget about your typical supply and demand stuff. Instead, it paints a picture of something much more dramatic happening behind the curtain. A classic short squeeze, but one of truly epic proportions. The argument goes something like this. Some huge financial player, we're talking someone with a balance sheet the size of a small country, was betting the farm that silver would go down. But when the price lurched up against them, they weren't just wrong, they were completely wiped out. And that triggered a chain reaction of forced buying that just sent the price into the stratosphere. And this is the central mechanism they describe. See, this isn't a negotiation. This isn't buyers and sellers figuring out a price. This is a situation where a clearinghouse steps in, takes over a bankrupt account, and unleashes a computer algorithm with one simple, brutal command. Buy back everything you need to cover the debt, and do it now, at any price. It just eats the entire order book alive. The source uses this really powerful metaphor for it, a whale dying. The idea is that the impact on the market is instant and just overwhelming. This isn't someone slowly getting out of a bad trade. It's a single, violent event that leaves a straight, vertical line on the price chart, a clear footprint, they say, of a total system failure. Now, the commentary argues a shock like this doesn't just happen in a bubble. A tremor of this size, it claims, immediately started to spread through other related markets, and it started with silver's much bigger, older brother, gold. So the first ripple effect, according to the video, is what happened in the gold market. The theory is that silver's incredible 10% jump is really just it playing catch-up to gold. They call this the high beta effect. Think of it like this. Gold is the big, steady aircraft carrier, and silver is the smaller, faster fighter jet. When the whole squadron gets the call to scramble, that jet just moves a lot faster and more dramatically. And this table here, this is the math they use to back it all up. They point to a gold price of over $4,500 and a historical gold to silver ratio of about 15 to 1. You do that math, and it implies a fair value for silver of around $300 an ounce. So from their perspective, even at nearly $80, silver is still wildly undervalued. The theory doesn't stop with just the paper contracts, though. It then moves into the real world, the world of physical metal. And the argument here is that the supply of actual, hold-it-in-your-hand silver is starting to seize up because of this price shock. And they point to these kinds of signs as proof. The video claims online dealers were suddenly pulling inventory, slapping sold-out signs on everything, or changing their pricing to call us for a price. They argue this is what happens when dealers can't reliably price or even get their hands on physical silver anymore because of the chaos. Okay, so this is where the argument really expands. It goes from a problem in the kind of niche silver market to a potential threat to the entire global financial system. And to really frame how serious they think this is, the source uses a phrase that is designed to send a chill down your spine, the Lehman moment. By bringing up the bank collapse that triggered the 2008 global financial crisis, they're suggesting that one big failure in commodities could kick off a similar catastrophic chain reaction. So how could this contagion actually spread? Well, they lay out a pretty scary domino effect. First, a huge firm defaults on its silver bet. The exchange has a rainy day fund to cover this. But what if the loss is bigger than the fund? Well, then all the other member banks are on the hook to pay the rest. The theory is this could cause all the banks to suddenly stop trusting each other, freezing up the credit that really keeps the whole system running. And this is what the source calls the ultimate trap. It's a real catch-22. If the system freezes, central banks would have no choice but to step in and print tons of money to save it. But that very act of printing money devalues the currency, which, according to this thesis, would just send even more people scrambling into hard assets like silver, making the original problem that much worse, a vicious feedback loop. All right, so we've talked about the cold mechanics of the market, but now the thesis pivots to something way more unpredictable: human psychology. It makes a prediction about what happens next when you and I, the general public, start to notice these crazy price swings. This leads to the next phase of the theory, and it's all about retail investors and media hype. The argument is that up to this point, this whole event has been contained to the big institutions and industrial players, but they say that is all about to change. And the first sign of the shift? Well, according to the source, it's in the search data. They point to a reported 300% spike in Google searches for how to buy silver as direct evidence that what they call a retail tsunami is just starting to form out at sea. The video then identifies $80 as this huge psychological trigger point. They argue that crossing that number would be like a flare in the night for the mainstream media. It's the point where the story could shift from just a rally to a full-blown mania, attracting a massive wave of speculative money. And the speaker makes a really key distinction here. They claim the underlying physical shortage is what gets the price to maybe $100, but the mania phase, the one driven by pure public fear of missing out, or FOMO, that's what could take it way, way higher. And that 10% price jump we talked about, they call that the starting gun that signals the race is on. So to summarize its whole position, the source makes this incredibly bold declaration. It claims that a decades-long period where the price was allegedly held down artificially has just been shattered. And now we're entering a new era of wild volatility, where the market is finally free to find out what silver is actually worth. And that is the central, provocative question this whole market commentary leaves you with. It doesn't give you an answer, but it gives you a challenge. It leaves you to wonder about the future of a market that, according to this wild thesis, has just been completely and totally unleashed.